Well, to help make sense of all that is going on in the markets right now, with all that news coming out from Europe and also news coming out here in the United States with the jobless claims numbers, we've got with us Tobias Levkovich. He's the managing director and the chief U.S. equity strategist for Citi Investment Research, and also, of course, Dominic as well. And Tobias is going to stay with us through the bell. And you're seeing right now markets rally because there is all this news out, not just the ECB rate cut, but also this news, this possible news about the Greek prime minister stepping down. All of that positives for the markets.
Generally speaking, the money flow is one of the big issues. So you're getting liquidity through the ECB right now, taking off some of the pressure that's been building. The Fed kind of said yesterday that they're ready to move in and implement additional programs if necessary.
Right.
So you've got kind of this liquidity flow that's supporting markets, even though we've got some of these really troubling issues, particularly around Greece and the debt. But it's spreading. It's not just Greece. We're seeing moving away from the periphery, if you want to call it that, into some core areas like Italy on the bond yields. So all this is kind of an interesting tug of war. And the grand concern, obviously, is bank sector contagion or new financial crisis like we had back in 08 into 09. I think that's probably overstating it at this stage. The numbers I always tell people is
why do you say that?
Well, let me give you numbers, because I like using numbers, not my opinion. It really doesn't matter what my opinion is. So from August 07 to August 08, what we saw in the U.S., for example, is high yield credit costs go from 6.5% to 12.5%, and that was pre-Lehman. So we already had doubled the cost on, if you want to call it, more leveraged companies. If you looked at investment grade companies, so better credit quality, they saw about a 200 basis point change in their financing costs.
Okay.
Well, business cares about their financing costs because they have to measure that against returns on their invested capital. Right now, high yield credit costs have gone up about 300 basis points, and investment grade have gone up 30 basis points. Corporates are in really good shape and can continue to invest. So it's not the same kind of financial trouble.
Well, they can thank the Fed for that, though, right?
Absolutely. But at the end of the day, what does it cost me to finance a project? And does it make sense to make that investment?
Well, how many times we've talked about this idea that traders say it's a headline-driven market, it's a headline-driven market, it's a headline. You say you don't look at those headlines anymore, right? You're of the school of thought that there are fundamental data points, there's evidence, hard evidence, you think, that supports a longer-term bull case going forward. So what are those pieces of data that are telling you that this is all kind of noise in the long term here?
Thanks for the question, Dom. I think there's a barrage of news or noise flow, and you got to cut through the signal. So the four things we watch real carefully, one which I just talked about is credit costs. The other thing we watch is valuation. Another thing we look at is investor sentiment, and then earnings expectations. So let's touch the other three that I haven't talked about. Investor sentiment. Our panic euphoria model is still in panic territory despite the rally in October, and that gives us about a 90% probability of gains in 6 months, 97% probability of gains in 12 months. I kind of like those probabilities. When I look at valuation, we look at earnings yield gaps. That is the 10-year bond yield minus the inverted PE, or the EP if you want to call it, and we're looking at 2 to 3 standard deviations below average. That has only happened in 57 weeks of the past 2,000, going back to the 1970s. In 93% of those instances, markets were up in 6 months, 96% they were up in 12 months.
Tobias, just hang on, because I'm just getting a headline right now crossing our Bloomberg terminal saying that George Papandreou, the Greek prime minister, he is said to fight on to remain as the prime minister in Greece, and he will be making a speech tonight. So that is contrary to some of the reports that we have had this morning, including from the BBC, that he is ready to step down. Instead, he is saying that he will fight on as premier, making a speech tonight. How is that going to help the markets? It's more confusion.
It's more confusion, and that's why you've got to cut through this stuff and not get swung around day to day by the emotions, because I don't think anybody can invest that way successfully, and that's why we kind of build these models to help us define what's going on. And on earnings expectation, last point I would say is that one of the things we found fascinating is we did a survey of our clients about a month ago and asked them, what do you think earnings are going to look like in 2012? And they're saying for the S&P 500 about $95, $96. Currently, the Wall Street sell-side analyst consensus bottoms-up numbers are saying about 109.
Wow.
So the investment community, the asset managers, are way ahead of the sell-side brokerage community in cutting their numbers in anticipation. So if you do cut the number and it's still above 95, 96, that's a positive surprise, not a negative one.
Tobias, I mean, we were talking with Barton Biggs earlier this week, who says, look, I'm not in Europe right now, but I've got to admit, it's pretty attractive there right now.
Well, our European strategists, John Stubbs, Adrian Catley, have been looking at actually the valuations, and you're back to like the early 70s, kind of 73, 74 timeframes on PE 20s in these stocks. So, and they are suffering in terms of the economic conditions. So there's some real argument to be made. These stocks do look very cheap. I think some better resolution to the problems that have been plaguing Europe are probably necessary to act as the catalyst.
But stocks here in the U.S. are multi-year lows in terms of valuation as well. So what's the better trade? Should you be buying those U.S. stocks or buying the European stocks?
Well, if you're worried about just the economic conditions, so for instance, more and more people believe there's a recession, either have started in Europe or will be there in 2012. Certainly, Citi's economists believe we're going to have contraction in economic growth in Europe next year. So that acts as a drag on some of the European earnings fundamentals. In the U.S., there does seem to be the greater likelihood that we're going to get economic growth. It's going to be, tepid, but economic growth is better than recession.
I know you've got a 1325 target on the S&P, right? What's going to be the catalyst to get us there?
It could be better news out of the super committee. It could be better news out of Europe. It could be just going the next few months and we don't get recession that is feared and people get some confidence. So you bring down the risk premiums, you get some valuation elevation. I think earnings are okay. And one of the things we've seen most recently in the earnings releases is guidance has started to tick back up. Now, again, in aggregate, not individual companies.
Okay, Tobias, great for you to stop by. Really appreciate it. Thank you very much, Tobias Levkovich. Right.